My name is Periklis Thivaios from IE Business School in Madrid. One of the things that I'm looking at is actually disruptive innovation in financial services. Now, having said this, fintech has become a big subject, particularly in the space of banking, and we hear a lot of innovators who are coming and trying to take market share, whether it is in the space of lending, portion of banks, payments, transaction processing, etc. So the key question I would like to address is it the turn of insurance companies now to be threatened by the whole fintech? Have insurance companies been lucky up until now? Have they been maybe less prevalent in the target? And are they going to be the next target in the near future? Well, in order to do something like that, what I would first like to do is to give a little bit of perspective to our listeners here in the conference. What are we talking about disruptive innovation and technological disruptive innovation? I think that's a quite important foundation stone to better understand why innovation came about, why the disruption is coming about, and what can we do about it. So I'm talking about two types of innovation. One is technological innovation, and the other one is business model innovation. Technological innovation means that we use technology to do something that we're doing before, probably better, faster, and cheaper. So selling direct insurance over the internet is something that I would call technological innovation. You don't necessarily need to have your agents running around. Now you can do it directly online. Technological innovation, as I said, is just a replacement of an action. Business model innovation is the development of a brand new business model based on the tools that are given to you by technology. Business model innovation, therefore, implies, to some extent, if I may say, growing the pie, creating new products. And this is where the big threat is coming from. So when we're going to have the conversation in March here in Amsterdam at Risk Minds, we're going to be looking at business model innovation and business model-based disruption. Now, the first question one needs to understand when we're looking about disruption is what industry are we playing in and who is our competition, okay? So usually the way that we've been thinking in financial services, banks have thought that they're in the banking industry and that their competitors is banks. And insurers have been thinking that they're in the insurance industry and their competitors insurers. Well, actually, we may have to make reality a little bit more complex. Are we really in just the insurance business, or are we in the underwriting business, which is fundamental to insurance? But at the same time, we're in the investing business. Of course, everybody will tell me that we are in the asset management business, and even things like, for example, pleasing our customers, something that I have to say maybe we're not doing that well as an insurance group. Therefore, by the first step, by defining which is the industry in which we're in, we can better understand, one, what are the threats that we are facing and who our real competition is. And this is something that those disruptive innovators are doing. And they're not saying, oh, I'm going to go and fight against insurers, or I'm going to go and fight against banks, but they actually understand a lot better a specific segment and say, how can I use technology in a specific case in order to overturn, in order to be able to capture some of the market share in that specific area. And these are the kind of things that we're going to look at. The last thing I would like also to discuss is the extent to what can insurers do. So here comes the threat. As I said, bankers have been facing this threat for a while. Insurers, we cannot sit complacent, but what can we do? Well, there's a number of things. Practically, one of the common responses that we see is to set up, for example, a subsidiary which is not part of the group and can focus on innovation outside. The benefits of something like that is that effectively you're creating an organization that does not carry the package of the big insurance firm. It does not need to go through these complex product approval processes, etc. Just like every solution, there's no silver bullets, has its pros and its cons. We're going to talk about them. An alternative which has become quite common is just buy out if you see any threatening startup. This is something which is it seems to be happening quite a bit. I have to say, because I do have a startup background as well, I do feel a bit sad that a lot of the startups are now being started just to be sold a few years later. But from an insurance point of view, this is a benefit, right? You have a bunch of young entrepreneurs who had a great idea, they try to put it together, and they're going to be very, very happy if you give them a couple of million and you have them out. So that's another target. Again, has its pros and its cons. We've seen it. This is something that we've seen in practice. I get asked the question quite often, so should we be afraid of Facebook? Should we be afraid of Amazon? Yes and no answers are generally always simplistic, and it's not something as simple as yes, you should be, or no, you should not. I would say maybe not be afraid, but we should definitely be conscious about these companies. Now, let's start with something, and I have to say up front, I've never spoken to somebody from Facebook or from Amazon or Google and whoever else you want to name to know whether they really have interest in entering insurance or not, but I would think that probably not, at least not the traditional underwriting business. In terms of underwriting, insurance do have a competitive advantage. They do understand their risks, they are very good at underwriting and developing their products. And if I were honest with you, if I were the leader of Facebook's Disruptive Innovation Unit, I would not really want to go and take underwriting risk on. There's a lot of things that you can do, that you take maybe some operational risk, but definitely not taking the underwriting risk that something like this would involve. Plus, on top of that, the fact that you need an insurance license, but I think these are easy problems to address. For example, Facebook already has a banking license. So a lot of the bankers I was talking to a couple of years ago, they were telling me, oh, but you need a banking license in order to do banking products. Well, Facebook now actually has 2 banking licenses, so that wouldn't really be the issue. The key question is, do they want to? And I would think that probably not. That doesn't need to make us complacent, though. That doesn't mean that they don't want to Facebook or any Facebook in the world, right? Let's also be clear that they wouldn't want to go and enter the insurance space. It's just that they will not go and enter the underwriting space. Again, we need to go to what we discussed. We need to understand what business are we in, okay, and what are the sources of advantage in the business. So an insurance firm is in the underwriting business, and the source of advantage in that area is having good underwriting processes. Okay, great. I would really doubt that somebody outside insurance could actually be as good as an insurer in underwriting. But then when we come to other things like product development, for example, collecting data that help the underwriting process, these are the areas where we need to be quite more conscious about. If we think the amount of data that Facebook carries, and again I'm picking on Facebook, about each of us is a lot more than what an insurer would ever get their hands on. Now, it's obviously legal for an insurer to create fake profiles and start tracking its users, but at the same time, if I were somebody who had access to Facebook data, and I could see that people go for skiing every 3 months, I would think that this person is a lot more risky to get a serious accident than somebody who the most common activity is maybe watching a movie in the sofa. So then the second thing is risk pooling, which is a fundamental thing that insurers are doing. There's a company called Friendsurance who are already trying to create the first round of risk pooling in between a group of friends. Standard theory, actuarial theory, will tell you that generally people will pay more insurance premiums than the potential loss that they would do, and you would expect that because otherwise we wouldn't make money as insurance companies. And then we go to reinsurers in order to protect the tail risks. Risk pooling could act something like this. Can we get a number of people together and have them to bring the first pool of loss absorbing funds before we go to the second tier, which could be an insurer or could be the concept of a reinsurer in that specific area. Third thing that is coming very strongly within the new technology platforms, and we see this across from everywhere, from Facebook to Uber to Airbnb. Everybody's rating everyone, okay? We used to have the situation where I would go to a hotel on booking.com and I would rate the hotel. I could have trashed the hotel and nobody would know, but now if I use Airbnb, I am actually a lot more concerned about my behavior because somebody can also come back and rate me. This power of these technological platforms is immense, because you can have a situation where everybody's rating somebody else, and the wealth of information you can get there is a lot better than me as a risk manager or as an agent going out and having a conversation with you and saying, all right, what are your favorite sports? And okay, I'm simplifying, but you kind of get the meaning of what I'm talking about. This was the end of my presentation. I look forward to discussing all of this in more depth here in Amsterdam at the Risk Minds Insurance event in March. But I would like now to open the floor to any questions that you may have.